International transactions not only include the transfer of goods and services, but also currency in an open economy. These transactions are conducted in the foreign exchange market. The exchange rate represents the equilibrium price at which currencies are traded, determined by demand and supply without government intervention. This can also be described as a floating or flexible exchange rate. You have two types of exchange rates, flexible or floating, and fixed. A fixed exchange rate system is one that is determined by the government for its currency and change for monetary and fiscal policy. A former term for this is a pegged exchange rate, but for the remaining of this lesson, we are going to focus on floating exchange rates. So let us look at the foreign exchange market in action. When someone from the United States buys a good from another country, U.S. dollars are supplied in the foreign exchange market and the foreign currency is demanded. When individuals outside the U.S. buy U.S. goods, the foreign currency is supplied and the U.S. dollar is demanded. The foreign exchange market determines the equilibrium exchange rate or price and quantity of currency exchange using the supply and demand curves for each currency. The exchange rate determines whether the currency has become weaker or stronger. When there is a decrease in the exchange rate for a currency, it has depreciated or weakened. For example, if an exchange rate decreases in the market for dollars, it means that it takes less of the foreign currency to purchase a dollar. This means it would take more dollars to buy the foreign currency. When there is an increase in the exchange rate for a currency, it has appreciated or strengthened. For example, if the exchange rate increases in the market for dollars, it means that it takes more of the foreign currency to purchase a dollar. Having an understanding of the appreciation or depreciation of a currency is key because it changes the price of imports and exports. When a country's currency appreciates, it is more expensive for people from other countries to buy their goods and cheaper to purchase their domestic goods relatively. When a country's currency depreciates, it is cheaper for people from other countries to actually buy those goods rather than purchase the goods domestically. So how does currency exchange relate to the balance of payments and the ADAS model? Let's begin with the ADAS model as always. Say that a government engages in either expansionary fiscal or contractionary monetary policy as shown with the proper models. Not only will this lead to an increase in price levels and output, but also in nominal and real interest rates as displayed with, again, the proper models. As a result, capital flows will increase into the country. Why? Because foreign investors love high interest rates. High interest rates will give them a return on their purchases on savings, bonds, and other interest-bearing accounts. This will lead to a stronger currency due to the increased price levels and interest rates. But unfortunately, as we have learned prior, strong currency makes goods expensive. Therefore, the country's net exports will decrease, leading to an eventual leftward shift in aggregate demand. Let's look at the other way around with contractionary fiscal or expansionary monetary policy with their respective models. This will lead to a decrease in price level, output, nominal and real interest rates. Due to the decrease in overall interest rates, capital flows will decrease for their country, leading to a weaker currency. A weaker currency means cheaper goods, which allows net exports to increase, shifting the aggregate demand curve to the right.